US stocks hit fresh record highs after the Fed's rate cut, with another 4 rate cuts forecast. Australia's jobs growth disappoints in August, and New Zealand's economy contracted much more than expected in the June quarter. That's coming up in our 5 Things in 5 Minutes on Friday, September the 19th. And then in part 2 of a deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes continues his analysis of the world's divergent oil market.
Any sort of source of cheap energy is quickly latched onto by the major sort of manufacturers and consumers of energy.
But first, in 5 and 5 with ANZ, US stocks continued their rally after the Fed cut yesterday and signalled more to come. The US 10-year yield also bounced decisively off 4.0% to be 4.10% by 4 a.m. Sydney Melbourne time. Here's ANZ economist Bansi Madhavani from London this morning on why there's plenty more rate cuts to come from the Fed.
The Fed expects the US economy to show modest recovery and sees no deterioration in the labor market in 2026. Tariff-driven inflation is seen as transitory, and the Fed expects its effect to wane in the coming months. When you put together, the Fed has a relatively healthy outlook of the economy. And when you consider that with the voting pattern and Chair Powell's press conference, it all suggests that further easing is likely, but the easing will remain gradual as long as there are no shocks to the labor market or economic activity. We are expecting that the FOMC will ease at each of its 4 upcoming meetings by 25 basis points each.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was up 0.6% and the Nasdaq up 1.1%, both new record highs. The yield on the 10-year US Treasury rose 3 basis points from its close yesterday to be 4.10%, although it did get to 3.99 earlier yesterday. Gold fell 1.1% to $3,674 US an ounce. West Texas oil futures were down 0.7% at $63.66 US a barrel. The US dollar index was up 0.5% with those higher US bond yields, with the Aussie dollar down 0.6% at 66.14 US cents, and the Kiwi down even more, 1.4% at 58.81 US cents after those very weak GDP figures. More on that in a moment. Number 2, Australia's jobs growth disappointed in August, with employment falling 5,500 compared to expectations for a 21,000 increase. ANZ economist Aaron Luck says the result could be off the back of public demand having eased in the June quarter.
But we'll get a better sense of the level of labour demand when we get updated job vacancies data from the ABS next week. But looking ahead, forward indicators are still looking pretty solid. We've got business conditions improving. We've got our own ANZ Indeed job ads being still quite elevated. So it's likely that the labour market will remain solid, and we do think that the unemployment rate will stay around the current levels.
Number 3, Australia's unemployment rate, though, remained at 4.2%. Aaron says the Reserve Bank of Australia should stick with the expected course of holding rates at the end of this month, with a cut on the cards for November.
We don't think that it will have a material impact on this month's decision. The RBA is widely expected to hold the cash rate steady. It probably won't have a huge impact on the November decision either, but it does reinforce the RBA thinking that we are moving closer to full employment, and the unemployment rate that's still tracking in line with RBA forecasts.
Number 4, New Zealand's economy contracted 0.9% in the June quarter, more than double the expected contraction. ANZ senior economist Matt Galt says weakness across services, construction and manufacturing led the fall.
The level of GDP is only just above where it sat at the end of the recession last year. So we had a steep downturn through mid-2024, a bit of a recovery over Q4 and Q1, but a lot of that's been reversed in Q2 with the renewed weakness now. So it does show the economy overall is struggling to find any growth, and it's been coming from a weak starting point. So all up that certainly reinforces the Reserve Bank's easing stance that they signalled at the August monetary policy statement.
Number 5, the result led to an increase in market expectations that the Reserve Bank could cut the official cash rate by 50 basis points in 3 weeks' time. Matt says the result doesn't quite meet the bar for a 50 basis point cut in ANZ researchers' view.
We're still anticipating 225 basis point cuts in October and November. The Reserve Bank's hopefully reaching the end of its easing cycle, and it will want to be cautious that it doesn't overshoot, having overshot both to the low end with OCR during COVID and then potentially over-tightened in response to the inflation that emerged. So they'll be cautious not to overshoot, but the economy is clearly weak, so more monetary policy easing is warranted.
Matt Galt there. Now, in part 2 of a deep dive interview on a divergence in the global energy market, ANZ senior commodity strategist Daniel Hynes looks at changes in the economics of industrial production and trade due to sanctions on Russian oil.
Energy is key to the global economy, and when you start to get different pricing mechanisms in the market, you'll tend to see economic activity adjust accordingly to that. Any sort of source of cheap energy is quickly latched onto by the major sort of manufacturers and consumers of energy, and I think that the risk here is that China and India, who are already sort of major manufacturers, global manufacturers, could potentially strengthen their grip on that industry due to the continued use of this cheaper energy that they're getting via Russia. It'll also result in closures in regions where the costs are higher, and certainly in the case of Europe, after having access to cheap Russian gas for so many decades, we're now seeing a lot of the heavy industry there suffer under the subsequent rise in energy costs now that they're paying higher priced sort of gas and oil, and are subsequently closing down operations. So it is having a meaningful impact on global trade and on global manufacturing.
Yeah, because the United States obviously wants India in particular and China to not buy all this oil from Russia, apart from anything else. They'd quite like India and China to buy a lot more of their gas from the United States, with Donald Trump wanting the United States to become a dominant again in global oil and gas. But and he's tried to pressure at least India by doubling their tariffs. But how's this going to end? Because so far it looks like India and China are saying gently no.
Yeah, generally is the key word there. Certainly, they don't want to antagonise the US any further, but for the moment, they're putting up a hand and saying, "Look, we will continue to purchase this cheaper energy from Russia." It's hard to really see where this ends. Certainly, India, I suspect, is hoping that eventually they'll come to some sort of an agreement with other aspects of trade with the US that will enable them to have those tariffs reduced. In the case of China, I think they've got a much stronger hand in this negotiation, considering there are certainly key sectors which the US relies on China still quite heavily. Certainly the battery, the rare earth sector, those issues came up when Trump and Xi Jinping played that tariff war early this year. It saw 100+% tariffs implemented. So it's certainly, I suspect, going to be a bit of a hurdle, I suppose, within the trade negotiations. But in the case of China, I suspect they can potentially withstand higher tariffs if that's the way the US heads with this pressure on buyers of Russian crude and gas.
So the irony here is that the United States is trying to bolster its own manufacturing sector and its own oil and gas sector at the same time as apply sanctions to Russia and those who buy oil off it. And the end result might be that its competitors in manufacturing, particularly China, get an energy cost advantage from this particular tactic.
Absolutely. Their manufacturing sector had already been weighed down by the higher energy costs, so this makes them even less competitive, and at the same time doesn't incentivise US suppliers of oil and gas to really ramp up output as well. So, it's a bit of a double whammy there. That sort of hope that Trump had of growing US oil supply by 3 million barrels a day looks a far-fetched dream at the moment, considering that the market, primarily China and India, continue to soak up these lower-priced sort of Russian cargoes of oil and gas.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, September the 19th. Catch you next week with a review of the Bank of Japan's rate decision later today. ANZ Research expects a hold. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.